Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler. He is Jim Wood. We talk money and investing. And, so we'll talk a little bit, I think we'll get into sometime this hour. Somebody had asked a little bit about the tax law changes and what do I thought about those. And by all means, I do not mind revisiting that particular topic because there were some interesting changes, of course, this year and how they apply. I think it's very fascinating to me that so much of the commercials that I'm hearing are, they're saying, now what do you do now? And there are a lot of investment firms that were having people do things from changing their portfolios or changing how they were going to be dealing with Roth conversions and those types of things. They were having people make changes even before there was any tax law, before we knew what they were going to do regarding the 2025, the expiration of the reduced tax rates.
There's always so many articles out there that come out like, well, this is what they're talking about in Congress, and this is what you might have to start thinking about, and all this. And yeah. I'm always just like, until I see some legislation that's passed.
Yes.
I guess you kind of have to know what they're thinking about passing, but there's so much, noise and confusion around what might happen and so much stuff that never happens that they talked about.
Well, the problem is people were taking action based on 2025 expiration of the tax reductions. And they were taking action. We saw it. And how do we know this? Because we'd have people come in here and go, this investment firm was telling people to do this. And they would hand us this book, which was a recommendation on what to do tax-wise with your IRA, converting to Roth IRAs, because tax rates were going to go up. That's what they were telling people, is tax rates were going to go up and you needed to make changes right now. And then all of a sudden, now the tax rates didn't go up.
Oops.
No, they're not saying oops. They're saying, oh, now here's what we ought to be. No, wait a minute. We already acted. And a lot of people, unfortunately, already acted when you said before that the tax rates were going to go up, and they went and did what you said, and now they're paying for it, which is sad. It has happened for a lot of people. Now, the other thing is this. As I see stuff out there all the time, Jim, where, somebody says, hey, we got this new book, on investing that you need to be checking out. There are these guys that go on there and talk about options. It's not an option. You've probably seen that before. They have this whole book on how to take advantage of options. Well, there was an article in the Wall Street Journal today. As a matter of fact, it was a hidden cost of playing the stock market slot machine. And I thought that was really interesting because it was talking about exchange traded funds that trying to magnify daily gains and losses in a single stock. Now, they're not trying to magnify losses. But that's how the article starts.
Yeah.
But
that's what they end up doing. But
yeah, that's exactly what they end up doing. But they were talking about here that you can magnify the gains, and some of the returns on some of these funds look like typos because they get lucky and they hit it out of the park, and that's what sells this stuff for people. Well, it says these returns are, they're talking about, how they actually put the returns out there, but it says the expenses on these funds. Now, number one, this may not seem like a lot, but, and it's not huge, but it's 1 to 1.3% on the funds. But here is what was really interesting. They said what the undisclosed costs can be in these funds. You know what the undisclosed costs went from? 15 to 20% annually.
We're talking hedge fund,
You are talking hedge fund. That's exactly right,
fees.
Jim.
Right.
Yeah. And it says that they had about $6.5 billion flowed into leveraged single stock ETFs. An ETF, an exchange traded fund that buys one stock. That is basically what these things are investing in.
People are they're always looking for the lottery. They always want that lottery ticket. They want the easy money, the easy way. They don't want to have to, work or be patient or anything. They want, it's in, fear of missing out. My buddy did this and he heard about this thing and he's really hitting it big. I want to do it too. And they just all sense, logic and everything else goes out the window. It's just excitement about this thing. And it's the dopamine hit of gambling, and because that's what you're doing.
Oh, it really is. And what happens is people have a fear of the future, as I say. Fear of the future. I don't want to miss out, maybe, is one of the fears. But another big fear is I don't want to run out of money. I don't want to, lose. I don't want to do something stupid and all of a sudden, I've missed out on something and my friend is, more successful than me. So I want to predict the future. That's the step 2. And how do I predict the future? I look for somebody that predicted the future in the past. So what I'm tempted to do is look for all of these hedge funds that happen to get good performance in the past. In the most recent 6 months, 12 months, 2-year period or whatever, I'll look at track record, and we're taught to look at track record in the investing industry. Financial advisors are taught to look at track record. And you say, well, Paul, what the heck else do you look at? And I would say what you look at is if I'm looking at track record on an asset class, I'm going to look at 100-year returns. I'm going to look at very, very long periods of time, 50, 60, 70 years, to give me an idea of what the cost of capital is in the asset class. Now, what that means in English is this. When we look at different areas, let's say if I were to lend money to one of two people. One person has their one foot in a banana peel and the other in a bankruptcy court. And I have the other person's very solid and stable and they pay their bills every single month. Who can I charge more interest to? I'm going to charge more interest to the one that is riskier, the one with one foot on a banana peel and the other in a bankruptcy court. So I would know that the cost for them to use my capital, my money, would be higher. That's just logical sense right there. I know that the person that is stable and solid, they don't have to pay as much to use my money. And hence, when they borrow to get a mortgage or they borrow for any reason, they pay lower interest rates. Now, I get that. Now, that is something that is repeatable throughout history, that very stable people pay less to use money. So that's the idea. If we're looking at big, stable companies, like blue chip companies, historically, they would have a lower return than a smaller company that has more risk involved with it. So therefore, when it comes to how much I will pay for each dollar of earnings, I will pay more for the earnings of a big, well-known company. I will pay less for a company that actually has, for those same earnings, but they're riskier. So I'm building in for myself a greater expected return. It's really, really simple. Now, what we're doing, though, however, when we're looking at past performance, we're looking at short-term past performance, and many times all it is this. What asset category just happened to hit it out of the park recently? And that would be, for example, recently, technology, anything AI-driven. Same thing happened, incidentally, in the late 90s. People bought things based on past performance, and they ended up with a bunch of tech stocks, and tech stocks dropped in value 80%. From 2000 on, in 2000, 2002, you had a huge drop in value. Now, so when we look at that, we're going, oh, I'm looking at past performance, but it's not indication of future performance. But what I do is I get overloaded. Everybody's telling me that they got the greatest thing ever. And then what I do is I make emotion-based decisions, like what Jim just talked about. He says, greed takes over. That might be the thing. Sometimes for people, it's fear. After a market downturn, that's why I hate risk tolerance. Because after a market downturn, nobody has any risk tolerance. They're risk intolerant. And after a market downturn, nobody wants anything to do with stocks. Well, what should we do when we know that stocks, when the markets go down, that's the time to buy, but we end up getting rid of things at that very point in time?
It's one of the biggest problems with investors is that misperception of risk. People see the market go down and they're scared to death. But are those companies now, they're much cheaper than they were a couple of weeks or a couple of months ago.
Much less riskier at that point in time, yeah.
Exactly. And things go up. People just think, I want to keep buying those things that keep going up because they perceive less risk because they've been shooting the lights out. But when in reality then, it's just the opposite.
That's exactly right. It's that perception that really gets them into trouble. So often what we do is we look for patterns, and those patterns may be false patterns, and that's the problem. Well, these funds right here, they're talking about this like trading costs on a conventional fund, financing costs in a leverage ETF. That's an ETF, an exchange traded fund that is borrowing money to magnify gains. If there's a gain, they can magnify it. That's what that leveraged ETF means. Aren't reflected in the reported expense ratio. They come out of the fund's total return. These expenses you pay without seeing them, they are not itemized. And this is something that I often point out to people. You hear these commercials for these mutual fund companies that aren't charging any management fees. They're not charging it. There's no trading costs. There are zero commissions, no nothing. And you go, how are they doing that? It's because the expenses are often hidden. That's how they're doing it.
I have that conversation a lot in terms of, okay, you have your explicit expenses, things that are listed in the prospectus, and then you have your implicit. And whether in active management, that's trading costs, from the buying and selling. And your index funds, there's things like the reconstitution effect.
Yeah, you don't think that there's any expense in an index fund, right? That's really low cost, isn't it? No, not exactly.
Yeah, well, the reconstitution effect just means that these funds aren't static. Sometimes they have to kick companies out, and sometimes they add companies. And when they do that, they announce it ahead of time, and those trades can be front-run by big institutions and things like that. And it's been estimated to cost people holding the fund about 1.67 on those companies that were sold and the companies that were bought. And so it's a true cost that is not listed in the prospectus.
That's exactly right. So, it was interesting because you mentioned that, Jim. And the other thing that, with indexing works in a couple areas of the market. Let me just make that point for those of you that don't listen all the time. Indexes work with really large companies. They typically work really well with large international companies. So maybe a small portion of your portfolio, typically less than 10%. For most people, I wouldn't have more than 10% of my money, no matter what your risk tolerance. I mean, literally, for most people, if I have enough choices in your 401k, I'm looking for your 401k choices. I'm trying to pick between things. I'm typically trying to stay less than 10% in large U.S. and large international, simply because where do I expect the least return? There. What can have long periods of low returns? That. It's because those companies tend to be very high priced compared to earnings, and they can go long periods of time with no returns. So hence, those areas, though, tend to index well because what are we going for? We're going for big. We're going for growth. And we're going for more, and growth doesn't mean that it's going to grow fast. Growth means that the companies are well thought of. Let me make sure. And well thought of companies don't have to pay much to use your money. But here's what happens is that we tend to de-emphasize that in the portfolio, but index funds work really well because they tend to emphasize that area, and that's why it works. The other areas, value, small, international small value, emerging markets small, and so on and so forth, they don't tend to work. Indexing doesn't tend to work that well there either. Now, another point that was made by an academic group that was teaching on this one day, I was sitting in one of their workshops, and they made the point. They said, hey, look, when we look at index funds, and the idea of indexing is you'll hear that it works better than active management, and that's absolutely true. Now, when we say, there are gradients, I say active management, I mean stock picking, market timing, engaging in that type of management of a portfolio. Index funds have been marketed as, hey, it's better than that, and it is absolutely true. But what you typically do in management of portfolio, what I'm looking for, is I'm looking for funds that don't actively manage, but they take the index, they take the companies that might fit in a certain area of the market, and they don't weight based on the size of the companies, number one. But they also, what they do is they remove the objectionable parts of the index. For example, in an index fund, you might have real estate investment trusts. You might have limited partnerships. You might have IPOs. You might have companies that are, you might have companies that are maybe nearing bankruptcy or something like that. So what we do is we want to remove the things that just don't make any sense from it. And what we do is when trading, it's not based on some company like Standard & Poor's or Wilshire or or MSCI or somebody like that telling us which stocks are going to be in the index. And the point that they made in this little workshop is that, think about it. Because there is an entity whether it be Standard & Poor's, whether it be Russell, whether it be Wilshire, whether it be, MSCI, there is a company determining which stocks will be in this index. That's stock picking.
Right.
And I thought, what a good point. Really, really.
And the other part of that too is that when you have a value index, typically it is not fully capturing the value premium of that area of the market. We talk about the value premium.
That's
small.
right.
Same thing with the small companies. The small index is not small enough.
Explain that in English, Joe. You said you're not capturing the value premium. Explain that in English.
Yeah, well, we've talked about the value premium on the show quite a bit, just meaning stocks that are kind of unloved, that people aren't willing to throw tons of money on are value stocks, and they tend to have higher returns long-term than growth stocks. And so if you're going to capture that premium for investing on the value side of the market, then you want to be, the technical term is price to book, the value of all the outstanding stocks divided by the assets of the company. And so the lower that number, the farther over to the value side that company is. And
higher expected return.
Yeah, exactly. And so that index is not going to capture all of that value premium compared to a fund that has a lower price to book overall that is further to the value tilt. In other words, the index funds are going to leave some of those premiums on the table when there is a capturable value premium.
And you want to make sure that, like let's say we're talking about smaller company stock funds. A lot of times these stocks in a small cap fund can drift into being medium-sized companies, mid-caps. And one of the points that was made in one presentation, they actually went through all of the different known indexes, the S&P 600. They went through the Russell 2000. They went through the various well-known indexes tracking small company stocks. And they showed how big of a difference there can be between the returns between these different index funds. And you say, well, it's just an index, right? No, not all indexes are the same. They're not all created equal. They're very, very different from each other. And a lot of people don't recognize when they just see index fund in their 401k at work, they don't realize which index is being tracked. And they don't necessarily recognize that maybe it's not tracking true small companies. When you're dealing with it, for example, a completion index. So let's say we look at the government TSP, Thrift Savings Plan. They have the S fund. S is small, right? You think small, S fund, right? And when you look at the S fund, it's a completion index. And what that literally means is it picks up where the S&P 500 leaves off, and you're holding mainly mid-cap or medium-sized companies. It's not really a small-cap index.
They should rename it the M fund.
I think they ought to call it the M fund. I think that works for me. Let's call it that. Okay. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, Paul Winkler along with Jim Wood. And, as I actually did Jim and I were talking during the break, I actually did a little video, an educational video. It's not out there yet, but we're getting ready for that Nashville rescue mission, the More Than a Meal-a-thon that they're going to be doing coming up. And they asked me to do a video teaching about QCDs, Qualified Charitable Distributions, and how they work. And this is the time of year where a lot of people have to take their required minimum distributions. Now, of course, with QCDs, you don't even have to be required minimum distribution age. You just have to be 70 and a half or older to do them. But it's a way, as I described it in the video, for people that have lost your deductions for charities because you used to itemize, Maybe you used to have, like, for example, mortgage interest. Maybe you had property taxes and your charitable contributions and medical expenses, and those things added up to enough where it was a high number or higher than the standard deduction. You would just do that. You'd file for those itemized deductions. And nowadays what happens is that if you go and use a standard deduction, now there's a little extra, charitable contribution that has been just passed in the most recent legislation. But, a lot of the new legislation was a real gift in that what happened for people that were worried about their tax rates going up from a 10, 12, 22, 24, 32, 37, 35, and 37%. Those were the tax rates. People were worried that they were going to go from 10 or 12 up to 15. They were worried that they were going to go from 22 or 24 up to 25. And actually, no, we had a renewal of that particular set of marginal tax rates, so that's been really helpful. But not only that, but the standard deduction went up. It was $30,000. Now it's up to $31,500 for married people. Half of that on both sides for single, which is a lot of money that you're able to deduct and not have to pay any taxes on income. That's a decent amount of money. It was a concern that was going to drop significantly, and that didn't happen. The other thing that actually happened, though, is for people that are over 65, you had another $1,600 per person for additional deductions for non-itemizers, and an enhanced standard deduction for people 65 and older of $6,000 a piece. And, so there's a lot of things that can be deducted, and that makes the new tax rules, and makes it really advantageous for people compared to what it was going to be if everything expired in 2025. Number one. Number two, the other thing was the estate tax. I was personally, with clients that have assets and investments, like, we deal with, some decent sized clients. And, it was a concern that they were going to drop down to a much, much lower unified credit where you weren't going to be able to pass money from one generation to a next. And they actually pushed that up to a reasonable level where most people aren't going to have to worry about it, $13,990,000, and that's per person. So that was a really good thing in the new tax law. It created a situation, just in short, for a lot of people getting into a big hurry on doing Roth IRA conversions. For many people isn't going to be an issue. For some people that were, rushing to try to beat increase in tax rates, it turns out that it was a bad idea to go pay taxes at higher marginal rates to avoid not necessarily higher rates in the future. So that is why that's all important right there. The other thing is the QCD, just talking about that, it's like giving you your charitable deduction back. And that's really how I approached it in the video that I did for the radio station. I just said, hey, look, for a lot of people that have lost their charitable contribution deductions, and they're not able to give much, because the tax issues regarding that. Now we have the ability to do that and take money out of an IRA, take it out of a pre-tax account, and have it go straight to the charity. And it helps you qualify for the RMD. It's, goes toward your RMD if that's a concern, but it's just a way to get the charitable contribution back, where if you're not itemizing anymore and you've lost that deduction, it's a way of, that's the way I like to explain it, of getting it back. So that's really why that's important, and that's why they asked me to do a video on that. So we'll have it on the website before too long.
And the thing with the QCD too that I like to talk to clients about is one of the first things, are you doing any charitable giving?
Yes.
If they have that IRA and if they're going to be 70 and a half, because I always just tell them that, okay, you can give $1,000 out of your bank account. That's money you've already paid taxes on. Or you can give $1,000 out of your IRA and have that money avoid taxes completely. So if you're paying any taxes at all, that is the logical choice because you get to avoid those taxes. The fact that if you have to do the RMD, that's bonus. But even before you hit RMDs at 70 and a half, if you're giving money away every month or anything or every year to your church or some other organization you care about, that QCD is a phenomenal way to avoid taxes on those funds that are going to get taxed someday, somewhere. there.
Yeah. And for a lot of people, when you're looking at the different assets that you have, there are certain things that if you're charitably minded, there are certain assets that are better going to charities in general, just simply because they don't have to pay any taxes on it. Like, for example, you might have a home, or you might have non-qualified investments, stock investments, and those types of things that get a step up in basis. When you pass away, they get up a step up in basis. In other words, let's say that you put $100,000 into something and now it's $500,000. And, just for the sake of it, let's say that you paid taxes on $25,000. Let's say if dividends or let's say short-term or long-term, hopefully not short-term, long-term capital gains. Now you've got $125,000, the 100 that you put in, plus $25,000 that you've already paid taxes on, and now you have $375,000 of gains. Now that's an asset that if you're living off of it, you may be living off of the asset, but you want it to go to somebody. Quite often, that is an asset that might be good going to a natural person because they get a step up in basis. And then you might have an IRA over here that you pass part of, or some of anyway, to a charity, because the charity avoids all taxes that way. Because if you pass the IRA to a natural person, they have the distribution. Now, for a lot of people, you have to distribute all of the IRA over a 10-year period. Now, the things they can do, a lot of times our clients will say, hey, Paul, make sure that if something happens to me, that you get with my kids and give them some guidance as to what to do with this, because sometimes what I'll have them do is they may actually change the nature of the portfolio and be more conservative with it, living off of some of the portfolio and then maximizing their 401ks to offset the distributions from the IRAs. And you have the taxable distribution, then offset it with greater contributions than you would have given to your 401k. So there are little strategies that you can use to deal with those taxes. But a lot of times, tax smart planning, when it comes to estate planning, it's just good to get in there and go, okay, what should I do? I had one client of mine had a large amount of money in a variable annuity. And he's like, we had to put him in a no-load, no commission, non-commission based variable annuity because he had a big gain in his annuity and he would have paid taxes on it had he pulled it out. So what I had him do is move it over there. And now the beneficiary on that, now he's living off of some of the money in it, but the beneficiary of that is his church. And the reason being is because annuities are quite often, they're an awful investment to inherit because of the taxation. So that's another problem that I have with annuities is the way they're taxed. They're last in, first out, which can be a problem tax-wise when you're pulling money out. You have to pay taxes on every dime coming out of the money that is first pulled out because it was the last to go in. It was the earnings of the contract. So, you just got to be really conscious of the tax treatment of these various things. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.